With what looks like the first rate cut in years to come sometime in September, many investors are racing to lock in rates on CDs, some of which at the moment are yielding more than 5%. While it's hard to argue with a nearly risk-free rate of that magnitude, investors ought to proceed with caution when hunting for high-yield CDs. In this video, I'm going to discuss the pros and cons of investing in CDs, explore some alternatives to CDs, and ultimately determine if CDs are really worth your time and money. Stick around and let's get into it. Welcome back to another video from OneUp Financial. I am your host as always, Eric Persogna, CPA and Certified Financial Planner, here to help you increase your income, reduce your taxes, and invest smarter. Today, we're going to be discussing CDs, given the recent hype around yield chasing that I've noticed in the financial media as of late. I feel like all of the media outlets right now are focused entirely on CDs. The benefits to CDs, the most high-yielding CDs, what to look for when investing in CDs. It's overwhelming and interesting when just a few years ago, people were talking more about like speculative tech stocks and the metaverse and NFTs, and all of that now has kind of been replaced with high yield savings accounts and cash and boring CDs. Now, cash has always been king, but now it seems like it's cool as well. And with 5% yields with little to no risk of loss, what's not to love, right? Of all the different cash alternatives out there, CDs seem to be the one right now that are getting all the attention, considering that the Fed is likely to cut rates here in September. So before I talk about the pros and cons of investing in CDs and some alternatives to CDs, let's first kind of define what a CD is. Even though I think most people are kind of aware, let's just kind of run through a brief overview of what a CD is. So CD stands for Certificate of Deposit, and it's a type of savings account that's offered by either banks or credit unions. And it allows you to deposit money for a predetermined time in exchange for a fixed rate of return until that CD matures. If you compare CD rates to, let's say, traditional savings accounts, CDs tend to have higher yields because they're rewarding investors for locking up their money for that set period of time. Now, I'd say in general, the yields are higher, and we'll talk a little bit more about that later. That's a basic overview of what CDs are. Now, there are other types of CDs out there that you can actually buy through like a brokerage that trade almost like a bond and can be tied to not just interest rates, like fixed interest rates, but also can be tied to market performance. But for today's purposes, for this video, we're just going to focus on the traditional CD that you would typically buy at a bank or a credit union. So now that we have a better idea of what a CD is, let's talk about some of the benefits or the pros to investing in a CD. So for starters, number one, the benefit I think to investing in a CD is the guaranteed rate of return. So when you open up a CD at a bank or a credit union, there's a certain rate that CD is going to pay. And when you put your money into that certificate of deposit, there's pretty much no fluctuation in that investment. If the CD rate is currently at 5% when you open that certificate of deposit, that's the rate of return you're going to get. Second benefit is safety. So certificates of deposit, whether they're through a bank or a credit union, are insured. And if you open up a CD at a bank, it's insured through the FDIC. And if it's through a credit union, it's insured by the NCUA. So that's a National Credit Union Share Insurance Fund, up to applicable limits. So for individual depositors at the moment, that is currently at $250,000, which means that if the bank goes under, then your CD, your investment, is insured up to, for an individual, $250,000. Last benefit of investing in a CD is, I kind of alluded to it before, is the potential for a higher yield relative to a traditional savings account, because investors are, in a sense, tying up their money in a CD for that predetermined set of time. They should be rewarded with a marginally higher yield on that investment. So now let's talk a little bit about some of the drawbacks to investing in a CD. Number one is lack of liquidity. Okay, so CDs have varying maturities, 3 months, 6 months, 9 months, year, can even be longer than that. And you pretty much, you can tap the money if you need to, you can pull the money out of the CD, but it's really not meant to work that way. Okay, CDs are meant to be invested in and then really held and not touched until they mature, which kind of brings us to the next disadvantage, other than the lack of liquidity, which is early withdrawal penalties. So technically speaking, you can access your money early if need be, but that bank is going to impose a fee on that CD, which is going to eat into your yield and ultimately make that CD really not worth your time and money. Third drawback is inflation risk. So these are not Treasury inflation protected securities. The rates pretty much stay the same. I talked about one of the benefits being that guaranteed rate of return. Well, that's kind of also one of the drawbacks, because if you have rising inflation, that rate on that CD is going to stay exactly the same. So it's going to kind of eat away at your purchasing power if inflation goes higher relative to what you're earning on that CD. Last disadvantage, and this is one I think that a lot of people don't necessarily consider when investing in CDs or bonds, is what's called reinvestment risk. So reinvestment risk is the risk that you have to take the proceeds of that CD when it matures and invest it into something that's yielding less in the future than what you initially invested in. And I think that's very relevant today, especially considering that Fed is looking to cut rates over the next several years. So if you lock in a CD now, that's great. You're going to get a higher yield today, but you have to have a plan for when that CD matures, because rates might not be as favorable in the future. Now, CDs aren't the only game in town when it comes to cash equivalents and cash alternatives. There are a lot of other options out there for depositors or investors to consider. And today I kind of want to focus on 3 other cash alternatives to CDs that you might want to take a look at. You're probably familiar with some of these, but there are some nuances to each one that I kind of want to go over. So let's start with number 1, and that is a money market account. So everyone I think knows what a money market account is. It's a savings account that you open up at, again, a bank or a credit union, and in exchange for depositing your money, you get an interest rate, you get some kind of yield on your cash. Money markets are a little different than CDs in several different ways. So one of them being liquidity. So with a CD, as I mentioned before, you pretty much can't touch that principal, or you shouldn't touch that principal before that CD matures. Whereas a money market, it's more liquid. You have access to that cash if and when you ever need to take it out at any given time. Money market accounts also have, on occasion, they'll have minimum balance requirements, which some CDs don't necessarily have, meaning that in order to open up a money market account at any financial institution, some banks may impose a minimum balance requirement, whether that's $5,000 or $50,000. Money market accounts can also have tiers. So if you want to deposit more money into a money market account, some banks will reward depositors with a higher yield. And the more money you give the bank, the higher the yield you'll get on that cash. It's a little bit different than how CDs are structured. Money market accounts, just like CDs, are FDIC insured and NCUA insured if you open them at a credit union. One of the big differences, though, I think, between money market accounts and CDs or even traditional savings accounts is that money market accounts can, depending on the institution, offer depositors check writing and debit card access. That's not something that you're going to get with a CD or with the savings account. If that's a feature that interests you, then a money market account might be a good option. But again, like with money market accounts, and later what I'll talk about is high yield savings accounts, banks generally limit the number of transactions per month. I think it's around 5 or 6 depending on the institution. So even though money markets offer check writing and debit card access, you really can't use it a ton. It's not meant for that. It's really meant for savings. Next cash alternative, high yield savings account. Now this is a little different than a traditional savings account that you would open, let's say, at your local branch. High yield savings accounts are generally offered by banks that only exist online. Okay, there's no brick and mortar. They generally don't have local branches. They exist online. Because they exist online, they don't have all of that overhead that a traditional bank does, and they can take some of that cost savings and pay depositors a higher yield on their cash. So a lot of clients will ask me, actually I had a lot of clients recently ask me, okay, well, there's a money market account, it's a savings account, and a high yield savings account is a savings account. So what's the difference, right? There's There's really not a lot of differences between the two. It really comes down to the features of each account. So as I said before, money market accounts have debit card and check writing access. Depending on the institution, they can offer that. Savings accounts generally don't have that. Okay, you can't write checks, you can't get a debit card with your savings account. Now, a lot of savings accounts don't have account minimums. So they might be better for someone with a small balance that wants to just start saving in just, a traditional savings account and doesn't have enough to meet that minimum requirement on a money market account. Other than that, they're very similar. They're FDIC insured, NCUA insured, much like money market accounts are. The yields, which I'll talk a little bit about later, are comparable, I would say, between high yield savings accounts and money market accounts. So really not a lot of difference there. It really comes down to, I think, the features of each account and really what's best fit for that depositor looking to park some cash and earn some interest. Third cash alternative, T-bills. Now, I know this might not be something everyone initially thinks about, but treasury bills or short-term US treasury bonds are another option for parking your cash for the short term and earning a yield of 5% or more, at least based on current rates as of today. Now, treasury bonds, T-bills are much different than money markets and high yield savings accounts in that they're not an account, right? They're an investment, they're a security. So they can typically only be purchased through an intermediary like a brokerage firm, or you can even purchase them directly through the Treasury Department at treasurydirect.gov, I believe, is the website. So T-bills, pretty much the way they work is they're just like they're an individual bond, and the bonds are issued at what's called a discount to par value. So for example, if you have a brokerage account, you open up a brokerage account at Charles Schwab, let's say, and you want to invest in T-bills as opposed to doing the high yield savings account or the money market. You would go and buy a T-bill with a face value of, let's say, $1,000, but you would only pay, let's say, $950 for it because it would be issued at a discount. You'd be buying at a discount to what that face value says. And then once that T-bill matures, T-bills have maturities that can range anywhere from several weeks all the way up to 1 year. When that T-bill matures, that is when you get your full interest payment. So instead of at maturity in that example, $950, you would get $1,000 back. That additional $50 would be your interest. So they're a little different than high yield savings accounts, money markets, and even CDs in that they don't kick off periodic interest payments. You get the interest payment at the end when that bond matures. T-bills also don't have that FDIC or NCUA insurance, but they are issued by the US government. So you have what's called a full faith and credit backing from the US government. They're pretty much considered one of the most risk-free assets in the marketplace, aside from money markets, cash, and high yield savings accounts. So no insurance, but full faith and credit of the US government. Liquidity. So let's talk a little about liquidity as it pertains to T-bills. Now, they aren't as liquid as, let's say, cash in a money market or a high yield savings account. But unlike CDs, you can sell your T-bill early if you want and not be penalized. Now, you won't receive the full interest if you sell out of that T-bill early, but you can sell that in the secondary market before that bond matures and get your cash back really without any early withdrawal penalties. Lastly, one of the interesting features with T-bills is that the interest that you earn on a US government treasury bond like a T-bill is exempt from state income taxes. And that's a little different than interest that you earn on a bank CD or a bank savings account, which do have state taxes associated with them. Now, the big question, are CDs really worth it? When considering everything that we just discussed, the pros and cons of investing in CDs and the three alternatives that we introduced, money market accounts, high yield savings accounts, and T-bills, are CDs really worth it? So in my opinion, if you're going to tie your money up for 6 months, 9 months, a year, you better be getting compensated for that illiquidity. In other words, the yields on those CDs better be meaningfully higher than those alternatives, the money markets, the high yield savings, and even the T-bills. Okay, so let's take a look at what the current yields are as of today. Now, I'm recording this video on August 23rd. So rates are going to be subject to change. They'll probably change like the second after I post this video. And also should mention that this is not a recommendation to buy or own money markets or T-bills or CDs. This This is merely for informational purposes only, so please do your own due diligence. So what I did was look at a few different sources. I typically go to bankrate.com, I go to investopedia.com, I go to treasury.gov directly to pull rates on T-bills. So based on the data as of, again, today is August 23rd, 2024, here are the current rates as they stand today. So I'm going to start with CDs. The highest yielding CD that I was able to find is 5.4%. Now, little caveat around that 5.4% was offered by a credit union located in Indiana that requires a $5 donation to a charity in order to become a member and get that yield. Nothing wrong with that. That's just something that anyone should be aware of when opening up a CD at a credit union in Indiana. Second, let's look at money markets. Top yielding money market that I found was 5.3%. Okay. High yield savings account, 5.3%. 3-month T-bill. So I try to find one that was comparable to that highest yielding CD. 3-month T-bill currently 5.28%. Okay. So quick recap: CD 5.4%, money market 5.3%, high yield savings 5.3%. and T-bill 5.28. Unless you're investing $10 million or more into one of these conservative cash alternatives, that additional 10 basis points or 0.1% that you'd be getting on that CD over the money market, savings account, and the T-bill isn't, in my opinion, worth signing up for a random credit union in Indiana and locking your money up for 5 months. Now, I should note that the other CDs that were a little bit lower than that high yield CD from the bank in Indiana were right around like 5.2 or 5.3%. So they're almost identical to the savings account and even the T-bill. So again, to me, in that scenario, based on the rates currently today, I don't see the benefit of owning a CD when you look at some of the other options out there. Now, you might be thinking, okay, if rates fall, which looks like the Fed's going to be cutting in September and maybe even more later this year, so too will the yields on money market accounts and savings accounts, which kind of would make CDs a little bit more enticing if you're looking to lock in some of those high rates today. But remember, CDs are taxed at the federal and the state level, whereas treasuries are exempt from state tax. So think about it. If you're in a high tax state, and let's take California or New York, for example, and let's say your state tax rate is about 8%. In that example, you would need a CD paying 5.7% to match an equivalent T-bill yielding what I said before, 5.28%. So I've literally I'm trying to play devil's advocate here. Like, what is the benefit? Why should I own a CD compared to all of these other alternatives? And at the moment, I find it really difficult to make the case for CDs, at least at this moment in time. What are you doing with your cash? And are CDs or some of these other short-term investments part of your investment strategy? Please leave me a comment below or shoot me an email. I would love to hear from you. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog. Thanks again, and we'll see you in the next one.